Accounting is the language of business. Like any language, there's a lot of nuance and jargon that needs to be fully understood if you hope to speak the language fluently. One of the terms that confused me the most early on was the concept of GAAP and non-GAAP. What do those terms mean and why are they important? We'll tell you in this video. My name is Brian Feroldi.
And my name is Brian Stoffel.
Thanks to Quarter for sponsoring today's video. Okay, Brian, let's get out with it. What the heck does GAAP mean?
GAAP is like an acrostic poem that's an acronym. It stands for Generally Accepted Accounting Principles. Now, what does that mean? These are commonly recognized set of rules and procedures that are designed to govern corporate accounting and financial reporting in the United States.
Now, in the US, GAAP accounting practices were developed jointly by the FASB and the GASB. That stands for the Financial Accounting Standards Board and the Government Accounting Standards Board. That means that GAAP accounting rules are applied to governments and nonprofits as well as profitable corporations. So what does non-GAAP mean? Non-GAAP just means using accounting practices that do not comply with GAAP standards.
So why would a company want to use non-GAAP metrics? Well, it doesn't make sense to have one-size-fits-all rules. GAAP accounting rules are black and white, and to try and apply them across the board misses some important nuances. By allowing companies to offer up their own non-GAAP metrics, investors can get a much more detailed view of the complex nature of a business.
Now, there are several instances in which GAAP and non-GAAP accounting cannot comply with each other. One of the biggest reasons why we see this happen in today's environment is due to stock-based compensation. Stock-based compensation is simply when a company uses its own stock in order to pay its employees and management team.
Now, there's a huge debate within the investment community as to whether or not stock-based compensation should count as an expense. According to GAAP rules, it should be counted as an expense, which will obviously then pull down the net income for that company.
However, when looking at a non-GAAP basis, companies often exclude stock-based compensation as an expense on their income statement. That obviously biases up their income statement to make it look better than it is.
Another example would be depreciation and amortization. These are non-cash charges in nature. However, on a GAAP basis, they count as expenses. In most cases, if a company offers non-GAAP measures, they will back out depreciation and amortization because there's no cash going in or out of the company based on this at the time.
Another relatively new category is unrealized gains and losses. Under GAAP accounting, those gains and losses are accounted for on the income statement, but oftentimes they're non-operating in nature. That's why they're often excluded when looking on a non-GAAP basis.
And finally, we've got to think about if a company decides to pay off its debt early. Obviously, that's a really good thing for the company. However, on a GAAP basis, all the money that left its coffers because of that count against the net income. On a non-GAAP basis, it's treated as a more positive event and they don't count all the losses from that payoff.
Now, there are a lot of common metrics that investors use when describing a business that often comply with non-GAAP accounting. A very common one is called EBIT. EBIT simply stands for earnings before interest and taxes. Essentially, EBIT is a look at a company's operating income while excluding expenses such as interest and taxes.
A close cousin of EBIT is EBITDA, which is earnings before interest, taxes, depreciation, and amortization. It means you're subtracting out the same things that you did in EBIT. However, you're also pulling out depreciation and amortization from your operating expenses.
How about another non-GAAP term that we both love and use all the time in this channel? Free cash flow. That is a non-GAAP metric, but we think it's a wonderful way to look at how profitable a company actually is.
Or if you invest in software as a service or SaaS stocks, you've obviously become familiar with the dollar-based net retention or dollar-based net expansion rates. This measures how much money a cohort of customers spend from one year to the next while factoring out new customers. That's obviously important because it lets you know whether or not the product is resonating with its customers.
Finally, let's talk about the big one, non-GAAP earnings per share. This is a very common metric that a lot of companies report to show how profitable they were during a given period. Now, given all those charges that we talked about that are differences between GAAP accounting and non-GAAP accounting, there can often be a wide difference between a company's GAAP earnings per share and it's non-GAAP earnings per share. Oftentimes under GAAP accounting, a whole bunch of expenses are included, while on non-GAAP accounting, those expenses are often excluded. That can lead to wide differences in the company's net income and hence its earnings per share. All right, let's show an example that really hammers home the differences between GAAP and non-GAAP accounting by looking at an easy to understand business, Walmart. Before we do that, we wanted to give a shout out to this video sponsor, Quarter. Quarter's mission is to make every interaction between companies and their investors meaningful. Quarter does so by providing frictionless access to conference calls, investor presentations, transcripts, and earnings reports from markets all around the world straight to your pocket for no cost. I've personally been using Quarter for over a year now because it makes it so easy to listen and track my favorite investors' conference calls, and I love that you can fast forward, skip, and even rewind the call. If you're interested in giving Quarter a try for free, simply visit the App Store of your choice and search for Quarter. That's Quartr. Thanks, Quarter, for sponsoring this video. Okay, Brian, let's take a look at Walmart's third quarter earnings of 2021, in which it recorded earnings per share of $1.11. That's on a GAAP basis.
Right. And Walmart did a great job of making it easy to see how $1.11 doesn't really tell the whole story. Here's why. First, the company showed that it recognized an unrealized gain in some of its equity investments. In other words, Walmart held shares of some other companies and those shares went up between the end of the previous quarter and the end of the current quarter. They said, that doesn't make sense to add on to our earnings per share because it doesn't reflect our core business. So we will subtract out that gain.
On the flip side, Walmart also paid off some of its debt during the period. That resulted in an 86 cents hit to GAAP earnings per share during the period, or 67 cents after accounting for taxes. This was a GAAP charge, but management doesn't believe that it should be penalized for that. Because of that, it's adding back that 67 cents when looking at its non-GAAP earnings.
So let's review what this means. The company reported GAAP earnings per share of $1.11. However, it subtracted out unrealized gains that it recognized from some of its investments, bringing it down to 78 cents per share. Finally, the company needed to add back in money that it lost on a GAAP basis for getting rid of that debt early. When you factor all of that in, earnings per share on a non-GAAP basis were $1.45. That's a 30% difference from where it was on a GAAP basis.
And when looking at those two numbers, me as an investor, I actually care a lot more about that $1.45 in non-GAAP earnings than I do about that $1.11 in GAAP earnings. And obviously, depending on which number you can use, that plays a big difference on the company's current valuation. Let's show another example that showcases that stock-based compensation thing that we talked about earlier brilliantly. Let's take a look at Fiverr's recent results.
In the third quarter of 2021, Fiverr reported a GAAP loss of 39 cents per share, or about $14 million.
That sounds bad. However, during the quarter, the company also paid out $15 million in stock-based compensation. That was a non-cash charge. If you exclude just stock-based compensation, the company would have swung from a loss to a profit.
But that wasn't all. The company also had to account a $5 million charge on some of its convertible notes. Again, a non-cash charge that would have added to those gains.
So when you account for those two major differences, the company actually reported a non-GAAP net income of almost $8 million during the period. That's a $22 million swing from a GAAP and non-GAAP basis.
And when we're talking about non-GAAP earnings per share, the company reported 21 cents positive. That's a huge difference from a loss of 39 cents per share.
Now, we're not here to debate whether GAAP or non-GAAP accounting is better or should always be used. I personally always look at the GAAP and non-GAAP numbers myself and see what the differences are so that I can make decisions as an investor. However, it is important that all investors understand the vagaries of GAAP and non-GAAP accounting so they can make better investing decisions. Brian's out.